In this week's extra recording, we're going to continue on with IAS 36. In particular, now we're going to look at the next area, which is the reversal of an impairment loss. And again, this is quite a practical issue where in previous years there was an indicator of impairment, for whatever reason, economic changes or internal issues, uh, and an impairment loss was recognized, where you wrote down the asset to its recoverable amount, which recognized a loss been recognized in the P&L. But what happened then is when those indicators then reverse, the economic conditions reverse or the asset becomes of more value, well then you may have a reversal of impairment. But the key thing here is not as simple as just reversing that entry that you put in before. What you have to consider is, well, what would have the depreciation been if it wasn't impaired? So it's a bit more complex that when you're reversing an impairment, the carrying amount of the asset is not increased above the lower of the new recoverable amount, if you can determine it, or the depreciated carrying amount had no impairment loss been originally recognized. So the logic is here, when you're reversing back the impairment loss, you have to consider, well, what would this asset have been at, its carrying amount, if it was never impaired in the first place? Because you can't impair or reverse it back above that. And then that will be credited to the P&L. Any reversal of a loss above that you go higher than this, is actually revaluation, because you're revaluing it above where it would normally have been if there was no original impairment occurred. Right, so that's important that we get an idea for that. There is one exception to the rule, and it's to do with goodwill. Now, goodwill will make more sense when we talk about cash generating units in a second, in terms of a collection of assets together, and goodwill forms part of that. But for your perspectives, it's an exception to the rule. You're not allowed reverse an impairment loss for goodwill. It's a particular type of intangible asset. You will cover it a lot more detail in AF3 with Karen next year, but just to be aware that it is an exception to the rule. So I think the easiest way to look at this is, let's look at a worked example. So on the 1st of January 2012, Black purchased a building for €2 million, useful life 20 years. And then at the 31st December 16, there was a development in the locality which reduced access and the attractiveness for tenants. So again, this was an external indicator of impairment. They reckon now at the end of 2016, the directors are Black, the fair value less cost to sell were 950 and the value in use was 1.2 million. And Black adopts the cost model under IAS 16, which means it doesn't use revaluation, it's merely holding it at cost less accumulated depreciation. So our first port of call is, what would the journal entries be posted for the year end 2016? Right, so we'll bring up this and we'll put these side by side. So we're saying in 2016, your net book value at the year end. Net book value at the year end. Calculate this first. So you have your cost. Your cost is 2 million. We'll put in the full figures just for completeness. And then we have accumulated depreciation. Now be careful here. This is where some students go wrong. They're not paying enough attention. It's from 2012 to 2016. That is, be careful, 5 years. Right? You have all 2012, all 2013, all 2014, all 2015, all 2016. So it's 5 years depreciation. Your annual depreciation is quite an easy one. It's €1 million. Sorry, it's 100,000, should I say. 2 million divided by 20. So if you put 2 million divided by 20, 100,000 times 5, 500,000. And put there 5 years. Just be careful. A lot of people will just see 16 and 12 and they'll say, oh, it's 4 years. It's actually 5. And that means the net book value, otherwise known as the carrying amount, 1.5 million. That is at the year end, 2016. We know now the recoverable amount is actually equal to 1.2 million because the fair value less cost to sell are 950. I don't ask you to calculate the value in use here. It's given to you directly. And the value in use is 1.2 million. So think of it back now. I have my carrying value, otherwise known as net book value. That's what it's in the accounts at. But I know now I can recover 1.2 million. So that means we have an impairment loss of 300,000. The asset is overstated in the accounts, so you're going to reduce the asset by 300,000. Bring it from 1.5 down to 1.2. And that's what the entries will be. Debit SOPL, impairment loss. So an expense, most likely go to admin expenses. Unless it's a material amount or significant, then it will have its own line item. 300,000. and you'll credit then the building. So you can just say credit building net book value. It's technically going to accumulate an impairment loss, but you don't have to show that separately. Just saying credit the building net book value is fine as well. So you're bringing that net book value from at 1.5 down to its recoverable amount of 1.2. That's your first key step. So that's what was asked for in 2016. Your impairment loss for the first time, and you recognize that it's an expense through the P&L. Now that shouldn't have caused students too much difficulty. It's the next piece that we need to be a bit more aware of then. So the next example is the same as before, but the next year, improved road access was provided and the value of the building increased. So again, another external indicator to say, actually, maybe we need to revisit this impairment loss. The recoverable amount at the end of 2017 is 1.5 million. So now if we come down to 2017, we need to know the net book value at the year end, 31st of 12/17. We have, if you go back, what we're given. So we have now, and I'll just put in inverted commas, the cost is 1.2 million, and accumulated depreciation then, this is where students go wrong, 1.2 million divided by 15 years. So this is where a lot of students get caught out. Your new cost now becomes what the recoverable amount is. So that's the baseline that you're going to use going forward. We're not told that there's any change in the useful life. So that means we assume there's 15 years left. There was 20 years at the start here. We used 5 years to get to 2016. So it must mean there's 15 years left on this asset. 1.2 million over 15 is 80,000. 80. That's a negative, of course. And that means your net book value at this date is 1120. The net book value at the date of the impairment test. But what we're actually told is this recoverable amount has increased back up. The recoverable amount now is 1.5 million. So this is where you have to watch the rules in IAS 36 in terms of dealing with the reversal of an impairment. You can't just simply, oh, we should reverse it back up by 380,000. Because hold on, if there was never an impairment in the first place, what would the net book value have been at the end of 2017? That's how much you can only bring it up by. So that's an increase here, 380. But you have to compare what would the net book value have been on the 31st of 12, 2017, if no impairment ever took place. And that's an important question because that will limit what you can actually show. It's over a bit. So we're looking at the cost was 2 million and accumulated depreciation. If it was to the end of 2017, be careful, you will have 6 years. 6 years, which is going to be 600,000. So we're saying this is what the position would have been if you never impaired in the first place. Because we're saying we impaired last year and now we want to reverse the impairment this year. But if we never impaired in the first place, the net book value would have been 1.4 million. This sets the max reversal. Right, that's important. That sets the max reversal. You can only reverse the net book value up to 1.4 million. Anything above that, bringing it up to 1.5 million, that would actually be a reevaluation. So revaluation under IAS 16. And they don't do that. We're told they're using the cost model. So that's a tricky one. So if you said, oh, we just reverse this reval or reverse this impairment, you're not actually reversing impairment. You're reversing it above what they previously was held at cost. So when you're dealing with a reversal impairment, you need to know what the net book value would have been if no impairment ever took place in the first hand. So max reversal equals 1.4 million versus 1.12 million, which is 280,000. You cannot reverse it above 280. That other 100,000 going from 1.4 to 1.5 million, that's bringing it above its true cost and its true carrying value. And that's not allowed under IAS 36. That would only be allowed if the asset was held under the revaluation model in IAS 16. And we're told in this question it's not. We're told it's held, if you see here, under the cost model. So therefore, your reversal will be credit the SOPL 280 and you will debit the building net book value 280. So you're bringing it from 1.12 million up to 1.4 million. And that's your, in inverted commas, the cost of the asset for 2018 and going on. Right? So that is an important aspect that students get their head around that. Right? Don't worry, you can adjust the accumulated depreciation and you can adjust the cost if you wish. Just give me the debit or credit in net book value terms is fine as well. There's no issue giving me in that. That's perfect in terms of an answer. But the key takeaway from that example is be very careful when you have a reversal of an impairment. It's not as simple as just going back and reversing here the impairment loss. That impairment loss was 300. But the key thing is here, notice why I'm only reversing 280. Because actually I've charged only 80,000 depreciation in 2017. I should have been charging 100,000 each year. So I've undercharged depreciation by 20. So that means I will under reverse by 20 as well. So there is a link there between the change in depreciation and how much you reverse. It's not as simple as just reversing this amount because you have to be conscious of what the depreciation adjustment was in subsequent years as well. And the easiest and cleanest way to do that is to look at what the net book value of that asset would have been if there was never an impairment in the first place. And that's the maximum amount you can reverse it up to. Right. So that's something you need to go back to. Have a look at the question pack. There's one or two questions in that pack giving you an example of how to deal with a reversal and particularly pay attention to the steps involved. It's very easy to get caught with the number of years and it's also very easy to get caught by reversing it up too much. Any reversal above its true net book value, which is this here, is technically a revaluation. It's not under the remit of IAS 36. IAS 36 is the lower of cost or sort of lower of carrying value and its recoverable amount. The correct carrying value here is the 1.4 million. That's why we only reverse it 280. If you want to go up to 1.5, that last 100,000 would actually go into OCI under IAS 16. So it's a different remit completely. But that will be clear in the question which model the particular company uses so you know what adjustments to make. All right, that's the first key area we wanted to cover off in the recordings today was the reversal of an impairment loss. The other thing we wanted to look at is a very practical issue now is, well, actually, in the real world in companies, most assets are part of a collection. They're not going to be standalone assets that generate their own cash flows. So a lot of plant and equipment is only really makes sense when you look at it as a collection of assets, like the Irish division. So you're looking at a part of a business. And we call these in IAS 36 cash generating units. So it's a smallest bundle of assets that generate cash, that they can generate an independent set of cash flows. So that might be a separate company, it might be a separate division, but a collection of assets together can generate their own cash flows. Because often a machine on its own cannot generate cash flows without staff, without patents, without a building. So you kind of have to look at them together. The other thing as part of CGU is this thing called goodwill. Now, goodwill is an intangible asset, and we'll deal with more about intangible assets in IAS 38. And it can arise as part of the acquisition of a business. So if you buy a business, like, and we'll look at an example in a second, Glanbia bought SlimFast, you may pay a premium over and above the book value of the goods. That premium we account for as an asset called goodwill. Right? It's not separate to all the other assets, so it's seen as part of the cash generating unit, right? And that goodwill has to be tested annually for impairment. So you don't wait until there's an indicator of impairment. Every year, you must test goodwill for impairment. So it's quite a controversial area in accounting currently in terms of very big goodwill figures. If you'll see in Glanbia or CRH's financial statements, goodwill is one of the biggest figures. And it's kind of an artificial accounting figure, this kind of premium that you've paid for assets, but you can't actually attach it to any one particular asset. So it is one that has courted a lot of controversy, and they're looking at possibly changing the accounting for goodwill. But said that's going to make a lot more sense next year in AF3 when you deal with financial reporting with Karen. So then we're coming to an example. Take Glanbia and SlimFast. So back in 2018, Glanbia acquired SlimFast for 350 million. But they paid more for the company than the combined value of all the assets. So why would they do that? Well, again, you're buying a premium. You're buying this intangible value in terms of future growth, in terms of future customers, potential, etc., the cross-selling potential. So that means in accounting terms, whatever the extra that we've paid, that additional premium, we call goodwill. And it will be on the statement of financial position, very significant figures, but it must be tested annually for impairment. So let's have a look at, for example, now just be careful here, this is actually Glanbia's report from 2018. The one I have up on loop is 2019. I left this in intentionally because it's a very good example. So if you go to, you can get it on Google, Glanbia's annual report for 2018, page 193 of their document. You can see that Glanbia acquired 100% of SlimFast and they paid 335 million. And they got all these assets and liabilities as part of it. That's the cash generating unit. And you can see here, they paid 335, but the fair value of assets they acquired was only 198 million when they added them all together. So most of this is a premium above that. It's called goodwill. It's essentially only a plug figure. Again, you'll deal with how to account for all of that next year when you deal with group accounting, but it's quite a significant figure. Right? Goodwill is a huge, big figure in a lot of these. Like if you look at Glanbia's annual report, the one I have up in loop for this year, and we look at the statement of financial position, one of their biggest figures is intangible assets, 1.3 billion. Most of that is goodwill, if you go to note 16. The same in CRH, if you go to their annual accounts as well, particularly their statement of financial position, balance sheet, intangible assets, 8 billion, which is again, a lot of that is goodwill. So it's a very important aspect of understanding in accounts is how to deal with a cash generating unit and how to watch for goodwill impairment. So when you impair cash generating unit, it's the same rules as an individual asset. We get the carrying value of the cash generating unit, what it's in the accounts at. We get the fair value less cost to sell. What could you sell that CGU unit at? And we get the value in use. What's the discounted cash flows of that cash generating unit? Our only problem becomes then, well, once we calculate if there is an impairment loss, we need some method to allocate it, because if we have a collection of assets, it's a bit more complicated than having an impairment loss on a single asset, where we know we allocate all of that impairment loss to one asset. So there is rules here around goodwill is the first to get impaired. If there's any impairment loss, you write off goodwill first. If that doesn't cover all the impairment loss, then you pro rata all other assets that are within the scope of IAS 36. Just note here, inventories and trade receivables are not within the scope of IAS 36. They have their own standards and rules. They're the two main exceptions. But everything else then is done pro rata. And an asset should never be reduced below its own recoverable amount. So if I ever tell you an asset's particular singular recoverable amount is X, it's giving you a hint that you can't impair it below that. But look, we'll see this in more questions as we go through in examples how this works. But the same rules apply now, the basic rules of get the recoverable amount, compare that to carrying value, and that will determine whether there's an impairment loss or well. After that, it gets a bit more complicated in terms of allocating that impairment loss, and we'll follow the rules in IAS 36 to deal with that. But let's look firstly at a good example. Right, so we have Beta Limited. The company has been experiencing difficulties for a number of years due to a downturn in the economy. Straight away, the flag, there is an external impairment indicator, right, because of the downturn in the economy. But also the fact that there's goodwill in one of these here, that means it has to be tested annually anyway, even if there's no indicator. You're given the carrying values at the 31st December 2017. So that's what we need. Carrying value for supply, carrying value for service. Two different divisions. Those two will be classified as cash generating units. Standalone collection of assets which generate their own cash flows. We're given the fair value less cost to sell of supply and service. And we're also, think about why I'm told that. Why am I told that the patent could be sold separately, for 15,000. So this patent here could be sold separately for 15, which means you cannot impair it below 15,000. You cannot impair it below its own recovered amount, right? Because that's what it can be sold for. Then you're given the cash flows for each division, and you're told the discount rate is 10%. They want you to prepare the journal entries for any impairment losses. So let's set this up and see what it's going to look like. Right. So the easiest thing is I'll set it up in Excel instead. It'll make it easier to follow, and we can keep a structure on it as well. So it's the same rules before. We have the carrying value, the carrying amount. We have the fair value less cost to sell, and we have to calculate the value in use. So we'll bring this over here. We'll put them side by side. So we look at here, supply and service. So the first thing we're looking for is the carrying amount. I'll just call it CA. That's given directly in the question. It's all the assets added together, 910 and 864. We know the fair value less cost to sell. It's also neatly given in the question, 751 and 738. Now remember, this does not guarantee that there will be an impairment, because we need to know what the value in use is first, because the recoverable amount is the higher of these, not the lower. So you can't guarantee that that means it's going to be an impairment. We need to know what the value in use is of both divisions first. And to get that, we look at the cash flows. You look at 2018, 2019, 2020, and 2021. Now again, I would urge you to practice this yourself. Don't wait for me to do it. See, can I get the present value of those? Either using a calculator, using the formula, the cash flow, divided by 1 plus R, which is 10% to the power of the number of years, or we can use our discount factor tables, otherwise known as your present value tables. So in 2018, for example, I'll make these a bit bigger so we can see them. In 2018, that's going to be 210,000, and I'm going to get the discount factor for that. We're going to use the discount factor tables. So I'm going to come here and I'm going to say present value tables. Now, ideally, you might have these printed out so you're not searching for them in the day of the exam. I'll use the same tables that we used in the lecture, the live webinar. So we know we're looking for 1 year and it's 10%, which is 0.909. 1 year, 10%, 0.909. Bear with me here. I'll bring this up as well. So that shows the formula, and that means the present value, 210,000 times 0.909. So about 190,000, there or thereabouts. Same logic for this one. It's going to be 207,000 times 0.909, because it's still 1 year, it's the first year's cash flows, and it's still 10%. It's just showing the examiner where the figures are coming from and using your discount factor tables. About 188,000. And that's fine. You don't need to round to it. You can round to a whole figure. It's perfect. Just as an illustration, if you did that using the formula, we'll use the calculator approach just to show the slight difference. 210,000 divided by 1.1. Again, you can put to the power of 1 if you wish, but there's no need here because power 1 is still 1. Is 190,909, which is slightly different than here, but only marginally. Both of those will get full marks. So you can either use the calculator approach or you can use the discount tables. Both are fine. We'll come on then, it's 205,000 times the discount factor for 2 years, if we open up again, is 0.826. For 10% for 3 years, 0.751. And for 10% for 4 years, 0.683. So hopefully that makes sense to you from your corporate finance module. Certainly, if that's causing trouble, don't be afraid to reach out with me, and I can do another couple of examples to help you along. So that's 0.826. It's going to be, if we open up the other cash flows, 275 times 0.751, and then 260 times 0.683. So we're just doing them all out so we can show you where the figures come from. So there's a bit of number crunching. and then 205 times 0.826. So I'm just taking those from the discount factor tables given that you can print off and have with you on the day of the exam. And if we add those up, the value in use for supply, about 744,000. 744. Again, you can tidy those if you want, but that's fine. So again, try that yourself. If you're happy now, pause this. Try see can you do for service before you look at my solution. Again, there's no point you just waiting and seeing, oh yeah, I could follow that in a day. Get a blank piece of paper, see can you calculate the value in use now for service, and can you finish the question? Is there an impairment or not? So for service, we're assuming these cash flows are fine, so it's 240 times 0.826, the year 3 cash flow 275 times 0.751, and the last cash flow 294 times 0.683. So again, you can use Excel on the day of the exam, but you'll have to bring it all into Microsoft Word at the end. So you can use it for calculations. It's very easy, then just copy and paste this into Word. I'll show you that in a second just for illustration. And then just 240 times 0.826. So if I add those up, 793. So just copy that format over. And we'll do formats. And we're seeing here the value in use there, but 794,000. Close enough. But there's a bit of calculations there. I've given you cash flows, but they have to be before interest and tax. You're assuming that's fine based on the word in the question. Other questions, you might have to do some work to calculate those. And you have to know how to get the present value. All right, so make sure you go back over those. There's plenty of questions in the question pack to help you along with that. All right. So what we're looking for here then, say for example, just to illustrate what you might be doing at the end of the year, if you're doing this calculation in Excel, which you can, like if you're keeping everything in Times New Roman, I'll just bring this down, you could change all the font to Times New Roman, say Times, and we're doing 12, say in the Microsoft Word document. You just Control C, all those cells, Control C, go to your Microsoft Word, which we're looking at already, make it a bit bigger, go down to the next page, and Control V, and you slot it in. And there's your calculation. Now you can move it, click and drag it like this if you want, but it's all there. You can move it, make it wider, you can make it smaller. This thing is just not playing ball. All right, so you can see it's pretty, you can move the columns. If you want to bring them over, you can move them back. It's just taking a second to load there, so bear with it. So you can move it over and back, but you can copy it in like that. So you can still do it in Excel, but you see the way I annotate my formulas to show where the figure is coming from. Don't just, if you're missing that, I mean, you're not going to get all your marks. You have to show your workings by annotating your formulas. But it's very easy, copy and paste it in. So there's nothing stopping you using Excel on the day of the exam. It can be quite quicker. You just have to make sure you're ready to bring everything in then in terms of the Microsoft Word document, because we need a Word doc or a PDF to submit to the examiners. So we have to figure out then, is there an impairment or not? Impairment question mark. Well, in our case here, the carrying amount is 910. The recoverable amount, if we look at it, is going to be 751. Recoverable amount is the higher of fair value less cost to sell and value in use. So yes, there is an impairment. And the impairment loss here is the carrying amount, the 910, compared to the 751. It's impaired by 159,000. Right, so make sure you're happy with that, where it comes from. You have an impairment of 159,000. Now, we'll deal with the debits and credits in a second, don't worry. But for now, it's just to make sure you know where that impairment is coming from and how it was calculated. You get the higher of the fair value less cost to sell and the value in use, and then you compare that to the carrying amount. Likewise here, the recoverable amount now is 793. And again, yes, you have an impairment. You pay 864 versus 793. It's impaired by 70,000. Right, so again, where I'm getting those in the question, I'm getting the fair value less cost to sell, I'm getting the carrying amounts. The only thing I'm left with then is to figure out the value in use. The trick is here, well, hold on a second. If I know I have 159 and 70,000, I know I'm debiting my SOPL 159,000 here. And I know I'm debiting my SOPL in terms of here, 70,720, 270, sorry. But the question is then, what do I credit? And that's the problem we have with cash generating units, because they have multiple assets. You can't just credit the overall figure because it has to go to each individual asset. And this is where you come back to the rules of IAS 36. You first get rid of any goodwill. So in our case here, we can credit goodwill 48,000, sorry. That's the first rule, is you credit any goodwill if it exists there. You can credit goodwill, so that's wiped out. For the rest then, if you look at here, you pro rata based on the carrying values. So in this example in service, there's nothing else. It all has to go to credit PP. Credit PP, the difference, 70 minus 48. There's no pro rata because there's no other assets. The only other asset in the service division is property, plant and equipment. So you'll reduce that by 22,000. Goodwill first, then here. For this one, you're going to credit PP and you're going to credit the patent. And how you do it is going to be 159 times 885 divided by 910. We're taking the pro rata. 885 of 910, which if you do in calculator, about 97% of the assets are property, plant and equipment. So they will get 97% of the impairment. So again, we'll just tidy that up to single figures. And you do the same for the patent. The patent is going to get 25 over 910, which is about 3% of the overall impairment loss is allocated to the patent. And that is about, if we tidy it up as well, just for presentation, about 4.4368. So updated patent is 25,000 minus 4,368. Just to prove it, 2632. So that's the key rules in IAS 36. Remove goodwill first, then pro rata. If there's no goodwill, you pro rata straight away. And you do it separately. Each cash generating unit is standalone. So some of them, not all of them will be impaired, some of them may not be. And the other little bit of information that's relevant here, we're told, is the directors believe the patent could be sold for 15,000 from the supply division. So that means when you're doing your impairment, it cannot go below 15. Now we've no trouble here because it only goes to 20,632, so it's well above its recoverable amount. So there's no issue there in terms of impairment going below. That's fine. It can stay at that. Right? You don't have to say, oh, well, it can't be valued above it. We're only concerned there if you're impairing it below its recoverable amount. What it's currently in that is now fine because you're not going below that. So just something to watch for. Cash generating unit, the first steps are fine. It's the steps after that that take a bit of getting used to, particularly in terms of the allocation. But I've given you at least 4 or 5 good exam level questions on that in the question pack. So make sure you can do your time value of money. And again, if we wanted to take that, change the Times New Roman, change maybe size 12 font, copy and paste it. And all we're doing then, if we're doing the exam, slot it in underneath. There you go. So there's nothing wrong with using Excel and copy and paste at the end. And if you have the formats done already, there's no messing. So the Microsoft Word Excel is not a big jump, just a bit of practice. And we'll have plenty of that over the next 6-7 weeks. All right. So that's a good example of a cash generating unit. So let's look at another one then. Is B limited? So have a read of it and we'll talk our way through it, how this differs than the other one. Okay, so in this question, they've identified an impairment loss of 60 million for cash generating units. The carrying amount is 160 as here, and the recovered amount is 100. So they've actually done the question for you. The reason I focused on this is there's a couple of assets in here that will not get allocated anything. i.e. trade receivables inventory. They're outside the remit of IAS 36. But importantly, and this is where students get confused, they are still included in the cash generating unit carrying value. So you do include them in the 160 to compare it to the 100 to get your 60 million impairment loss. What you don't do then is you don't allocate anything here. So when we're coming to our allocation, right, we're trying to figure out how do we allocate that impairment loss. You're told the fair value less cost to sell of the unit's assets do not differ significantly from the carrying values. No, that's of course except, spelled by me, for property, which is a market value of 70 million. So we're told the property market value is 70 million. So actually, it won't get impaired at all because its recoverable amount is higher than its cost. So you don't repair that down at all. So that means we're left with goodwill, machinery, and motor vehicles. So let's just talk our way through this because this is a kind of a good example of a trickier one. So the impairment loss is 60 million. Trade receivables, inventory are not allocated any outside IAS 36 remit. And that will get you the marks in the exam. They are included in calculating the impairment loss, but they're not given an allocation of that then because they're done in IAS 2, lower cost to net realizable value, and IFRS 9, dealing with the expected credit loss, which we'll deal with next year. Also, property is not allocated any impairment as fair value less cost to sell is above net book value. So the recoverable amount, which is the fair value less cost to sell in this case, because we've no value in use, that's higher than the 60. So it doesn't make sense to write it down below 60 because it's not causing the issue here. The key issues in terms of this impairment loss is goodwill, machinery, and motor vehicles. So you're going to debit the SOPL, 60 million. You're going to credit goodwill, 20 million. And that's the rule again from IAS 36. Goodwill always gets written off first. That's the first one always to take the hit, and that can never be reversed under IAS 36. Because it's the one that's most subjective. It's essentially an artificial plug figure. It's the one that's most sensitive to any write-off. And then you're going to credit machinery, and you're going to credit motor vehicles, what's left. In this case, you have 40 million left, 40 million of impairment left, and you're going to do it 2/3, 1/3, times 40 over 60, and then there's only two of them, so it's times 20 over 60. So 2/3, 1/3, because they're the only other assets that are getting allocated. So that's just an added complication that you will see in some of these questions where, number one, trade receivables inventory are never allocated an impairment. They're outside the remit. And number two, if there's a particular asset, an individual asset, whose recoverable amount is given, you cannot impair it below that. So in our case, you cannot impair the property at all because its recoverable amount is actually higher. It has a market value of 70. So it doesn't make sense to be writing down that. That property is not causing this issue overall. These assets, the goodwill, the motor vehicles, and the machinery, must be the ones that are causing issue in terms of the overall impairment loss. So that's 40 times 40 over 60, and that's 40 times 20 over 60. And we'll just round those to 1. So 26.7 million and 13.3 million. And that's your 60 million allocated overall. Right, so that's just important that you get an idea of that. You will see that in some of the past exam questions. That's really exam level tricks now. Now, the initial part will be getting marks around calculating the impairment loss. I very rarely will give you what the impairment loss is, but you'll get marks for that. You'll get marks for calculating the value in use. But really, to differentiate the very good students at the end, you might get one or two little tricks like that that you've paid attention to as well. But so don't get caught up too much on that for now. Focus really on the basics, the definitions, how to calculate the impairment loss, and the core journal entries. All right. So I've given you two good examples, one from Columbia, if we look at it here, and we said it's page 163. You can see here all the cash generating units, the impairment test for goodwill. That's how much goodwill they have. And you can see these are all the cash generating units, which have significant amounts of goodwill. So Performance Nutrition, they own, for example, Isopure as a business, Body and Fit, Amazing Grass, and then you see SlimFast. SlimFast now has goodwill of 112 million in North America and 26 in the UK. So every time they buy a business, there's goodwill attached to it. And their discount rate that they use is specific to each business. So they give all that information around how they calculate the impairment test each year. And they tell you about the discount rates they use, they tell you about the cash flows that they use. They're based on 3 years. And they also tell you about the growth rates, the assumptions that they use. And that's all about impairment testing, particularly the impairment testing of the intangible assets around goodwill. Goodwill is a very important and specific intangible asset. We'll cover that IAS 38 next week, but it's very much linked to IAS 36 as well, in terms of the cash generating units that they have. The other one that's a good example there, I have it down if you want to have a read of it, is CRH, page 159. So just have a look at CRH, because again, they're very acquisitive. They buy a lot of companies. Page 159. Gone the wrong page. Note 16. Sorry, I might have given it the wrong page there. Tangible assets. And you come down. Annual goodwill testing. You can see here, they tell you the number of cash generating units they have. So this business has 25 cash generating units. So think about the amount of work there. They have to do individual tests, like that we've done there for supply and service, those 2 questions there. They have to do that for every one of those 25 different cash generating units. And there's 8 billion of goodwill attached to them. So see, that's why it has to be done every year, because it's so sensitive. And it's such an important figure, material figure, that you have to give it a lot of detail. So they give you an idea, they use a 5-year cash flow forecast. They give you a range, the discount rates that they use, and of course they're pre-tax, like IAS 36 says. And they give you an idea of where the uncertainties are. And so they give you an awful lot of information. So they give you examples here, for example, the value and use of America's cement and the excess of value use over carrying value. So the value and use is bigger than the carrying value. It's not impaired. So they show you that for 2 of the big divisions that they have, America's cement and America's building products. So sorry, that should read page 169, not 159. That's a little typo on my part. And it shouldn't be note 16. Oh, it is note 16, sorry. It's a 169 instead of 159. But again, every listed company you will see any of those annual reports, there's going to be multiple cash generating units. So you can appreciate the amount of time, the amount of calculations that's involved in that every year. And that's part and parcel of the application of IAS 36. And you'll see those when you go through the more detailed exam level questions. There can be a lot of computation in it. In terms of IAS 36 versus the UK and Irish GAAP, there's less disclosure requirements under FRS 102, but most of them are very similar in terms of calculations and the rules. Right. Now, Section 27 also covers impairment of inventories, whereas we have our own IAS 2 in the International Accounting Standards, which deals with inventories. But in terms of the overall bulk of the standards, they're quite similar in terms of the key rules and the key accounting. Right, so your next step, once you've this looked at, is maybe Connolly Chapter 10 is quite a good textbook. It's available in ebook format from the DCU library, as is Elliott and Elliott Chapter 17. Either of those will be a good read, just to supplement what we've covered in class. And then go and have a look at question pack 10, which is a number. Particularly questions 1 to maybe 4 or 5 are quite basic ones, quite short questions, just based on a couple of key things. You then, from question 5 onwards, start talking about cash generating units, and you'll keep going down along that until nearly you come to questions 11 and 12, which are past exam questions, and they'll give you a very good benchmark of where you're at. But again, try not to do them all together. Try and pace them out, and certainly in the intervening period, have a look at least one of those chapters in the ebook format, just to read around the standard as well, because it's quite computational. It's a step up from the shorter ones we've covered to date. All right, so that was the extra recording for this week, week 7, looking at IAS 36. Next week, week 8, we're going to move on to IAS 38 intangible assets, and IAS 40, investment properties.